Hello dear students, this is financial management course designed for MBA students of Kushland College. It has 2 credit hours and I am Kafialu Taddese, assistant professor, and you can contact me using the telephone and the email addresses provided here. Let us start with the course, which is chapter 1. It is about introduction to financial management and analysis. This course is very much interesting because it is designed particularly for MBA students, because this course is all about the corporate finance. In other terms, we can call it corporate finance because it is designed just to serve the business management or business financial management. So, as you can see, uh, the overview of finance. The finance is application of economic principles to decision making that involves allocation of money under the condition of uncertainty. This means finance is all about how to effectively allocate the scarce money, scarce financial resource in the condition of uncertainty. Therefore, it helps a lot in effectively running our business and to properly finance our activities of the business. So, in other words, finance, as far as finance is concerned, we worry about money and also about the future, because our decision as far as business is concerned is most of the time related to the future. Future is uncertain, so in the decision of just using money, allocating money in the future, these two things, these two just associated factors are the critical ones. Therefore, finance tries to make use of money in the uncertain future. So investors allocate their funds among financial assets in order to accomplish their objectives in the business, and governments raise funds by issuing different claims against themselves, and then use those funds for operations. So in general, as you can see, in finance we worry about how to get money through different mechanisms and how to effectively use that money to achieve the business goals. So it in general provides framework for making decision as to how to get funds and what we should do with those funds once we got them. So it is a financial statement that provides platform by which funds are transferred from those entities that have funds to those entities who need funds. Therefore, in the financial system, these things will be facilitated. As you may know, one is not necessarily required to have all the necessary financial resources that help us to run the business, but he or she can borrow from some other sources who have a surplus of money. Therefore, in general, the financial system facilitates these things. Therefore, as far as the finance is concerned, there are three interrelated issues or areas where finance is applied. The first one is financial institutions. As you may understand from the term itself, financial institutions are those institutions which facilitate transfer of money or just uh, um, taking money from those who have surplus money to those who are cash or money hungry. Therefore, the area of finance deals with the banks and other firms that specialize in bringing the suppliers of the funds together with the users of those funds. For example, if you take a manager of bank, he or she may make decision regarding uh, granting loans, managing cash balances, setting interest rates and loans, and dealing with government regulations just with the sake of just obtaining money from the depositors and just lending money to the borrowers. Therefore, this is a typical activity of financial institutions. So, financial institutions are different in type. If you take bank, for example, if you take insurance, if you take uh, microfinances, saving and credit associations, these all are different forms of financial institutions. Therefore, financial institutions just facilitate the transfer of money from those who have surplus money to those who are in critical need of money. The other one is investment management. This is a second area of finance, and this investment management, as we try to indicate, is just helpful in order to effectively uh, invest our financial resources in most viable investment opportunities. So mind you, in order to just achieve a business objective, you have to just appraise different investment options to select the best ones. So an investment manager's task, for example, may include valuing common stock. Common stock is simply the share of ownership of corporation, uh, and selecting securities for a pension fund or measuring portfolio's performance. This means, in short, the investment managers are concerned with how and where should they invest the money they obtained in order to achieve their business objective, in order to become profitable, in order to make more money. Because the money that has been obtained should be properly invested, it should be properly allocated or properly deployed to the productive investment areas. Otherwise, the money which we borrowed is of its own cost, and then it may not be affordable by anyone if that money is misused or if that money is not properly uh, just allocated in a product investment area. Therefore, this is the second area of finance, and the third one which we are going to deal with in this course is financial management. This is sometimes called corporate finance or business finance, and this area of finance is concerned primarily with financial decision making within a business entity. It is with this reason that it is called corporate finance. So financial management decisions include maintaining cash balances, extending credits, acquiring other firms, borrowing from banks, and issuing stocks and bonds. So, in general, the role of financial manager is to make the money available for business purpose and then properly use those money made available for the business purpose. So regarding the investment decisions, because financial managers are also concerned with investment decision, we are concerned with the use of funds anyways. So the one major area of financial manager is just to make appropriate investment decision, and the other one is the financing decision. Financing decision is concerned with how to procure funds that are used for the business purpose. So, financing decision is concerned with how to get money, and the investment decision is concerned with how to use money. Therefore, these are the two big areas where financial managers are expected to exert effort. So, financial management decisions in general could be capital budgeting. This is simply appraisal of different long-term investments. Appraisal means evaluation of long-term investment options just to come up with the best option, the best alternative area of investment. The second one is capital structure. Capital structure is just deciding, or capital structure decision is concerned with deciding on the proper mix between the equity and debt. This means financial management is, as we tried to say, concerned with how to get money. So the money are obtained from basically from two sources. The first one is from the contribution of the owner themselves, the owners themselves. This is equity. And the other one is borrowing from external, from bank, it could be from other financial institutions. This is called debt, or it is credit. Therefore, the capital structure decision involves what proportion should be borrowed from external and what proportion should be raised internally from the owners. So this is another important area or decision area for the financial managers. The other one is working capital management. This area of decision for the financial managers is concerned with simply how can we make the financial resource available for the sake of just covering short-term liquidity problems, or in general it is concerned with the current assets and the current liability issues. So it refers to the firm's short-term assets such as inventory and its short-term liabilities such as money owed to suppliers. So managing the firm's working capital is simply facilitating a day-to-day activity that ensures the firm has sufficient resources to continue its operation and avoid costly interruptions. It is simply helpful just to carry out the day-to-day activities smoothly, and it involves number of activities that are related to firms receipts and the disbursement of cash. It is about anyways short-term assets, current assets and the current liability. So these are the three most important decision areas of financial managers. When we go to goals of financial management, there are many goals that we can mention actually, but these are the most important ones. Just to survive, financial managers try their best to make that business survive in the turbulent market environment, just by making the necessary adjustment to the business as conditions change. Avoid financial distress and the bankruptcy. This means the of course, in order to survive, the business should be just should avoid fear of bankruptcy and financial distress. Bankruptcy is the situation in which organizations may be forced to go out of the market through the court filing system. The other one is bid competition. The financial managers are concerned with just working day-to-day activities in order to win in the market, in order to beat the competition in the market. The other one is maximize sales or market share. This is the ultimate objective of financial managers. They have to boost their revenues, they have to gain market share ultimately, and then minimize costs, maximize profits, and maintain steady earning growths. These are the things that the financial managers are expected to do. In doing so, there are economic profit versus accounting profit. In just trying to achieve the goals mentioned, we have to differentiate between economic profit and accounting profit. Simply, economic profit is the difference between revenues and the costs, where costs include both the actual business costs, which is the explicit and the implicit costs necessary. For example, the explicit costs are the costs which are out of pocket, which are visible, which the business incurs, and the implicit costs are the payments that are necessary to secure the needed resources to the cost of capital. These costs may not be directly out of pocket costs, but they are the costs that are assumed. For instance, those related to the opportunity cost. And when we come to the accounting profit is concerned with only the explicit ones, not the implicit one. So the implicit costs such as opportunity cost and normal profits are not considered in the accounting profits. The financial management and the maximization of owners' wealth is another area of our concern. Financial managers are concerned with maximization of owners' wealth, practically speaking. For a corporation, that responsibly translates into maximizing the value of shareholders' equity. If the market for stock is efficient, the value of the share of the stock in corporation should reflect the investors' expectations regarding the future prospects of the corporation. So anyways, in the business, there are two conflicting parties' interest. The first one is the principal interest. Principal is simply the one who delegates somebody to act on his or her behalf. And for instance, in business, the principal are the owners, and the agent is also another party. The agent is the one who acts on behalf of the principal, and this agent is in business most of the time the managers. Therefore, the two try to maximize their own personal benefit. Therefore, in doing so, the conflict may arise, meaning that managers try to maximize their own personal benefit, sometimes at the expense of the owner's interest. Therefore, this creates conflict of interest. Therefore, the problems with agency relationship exist. It means in an agency relationship, the agent is charged with the responsibility of acting for the principal. The agent may not act in the best interest of the principal, but instead act in his or her own self-interest. Therefore, this necessitates actually working on the agency relationship. In fact, there are costs of agency relationship. There are costs involved with any effort to minimize the potential for the conflict between the two parties, and such costs are called agency costs, and they are of three types: monitoring cost, bonding cost, and residual loss. Monitoring costs are costs incurred by the principal to monitor or to limit the action of the agent. In a corporation, shareholder may require managers to periodically report on their activities through audited accounting statements. This is this involves cost actually, because in order to limit the action, in order to discourage the agents uh, adverse action against the owners, the uh, financial system or controlling system may be designed, and this involves cost. The other one is bonding cost. Bonding cost is related to the fact that bond is simply the promise. So bonding costs are incurred by agents to assure principals that they will act in the principal's best interest. The name comes from the agent's promise or bond to take certain actions. So a manager may enter into contract that requires him or her to stay on with the firm even through another company acquires it. Agency costs. So the resulting cost is called the residual cost, is the implicit cost that results because of the fact that the principals and agents' interest cannot be perfectly aligned even when monitoring and the bonding costs are incurred. Therefore, even if monitoring and bonding costs are there, still there are mismatches of those things. Therefore, these things need to be taken into consideration. Therefore, what are or how do we motivate managers in order to reduce the agency problem, the agency relationship problem? The first one is actually the one which is actually recommended is executive compensation, including salary, bonus, stock options, performance shares, uh, stock appreciation rights, and so forth. Therefore, anyways, by doing these things, at least the conflict that exists between the owner and the manager may be reduced, maybe significantly. So, in another area, shareholder wealth maximization and social responsibility is a matter of necessity as far as businesses are concerned. These things need to be considered, and the shareholder wealth maximization and accounting irregularities are also there, because um uh, in trying to achieve a given objective, there are irregularities that are created. For example, recently there have been number of scandals and allegations regarding the financial information that is being reported to the shareholders and the market. Many misuses of resources are there, and by creating irregularities, financial results reported in the income statements and the balance sheets of some companies indicate much better performance than the true performance. So managers and other parties may try to just make that there is financial profit, there is high level of uh, wealth maximization, even if it is not practically existing. Along with these financial reporting issues, The independence of auditors and the role of financial analysts have been brought to the forefront actually, because in the process of just wealth maximization there are irregularities. Managers may deliberately try to pretend that they are doing well, even if they are not doing well in real sense. Therefore, these are briefly all about the first chapter, and I hope you got something very good out of this. Thank you. Next time we shall come up with with other videos.